But with everything that's going on right now, I think everything has been put on hold. But we do have offices in New Jersey, Livingston, Wickliffe Lake, and outside New Jersey. We also do a variety of accounting and tax. Gift and estate is one of them. Forensic accounting, as I said, auditing and bookkeeping. So a whole full service accounting firm. So today we're going to talk about a very exciting topic of taxes, and it's a crazy time because it's, what is it, April 23rd, and we're still talking about taxes, even though the tax deadline was or is April 15th. In fairness, though, I was supposed to do this a little bit earlier. I think I got bumped about 2 weeks ago. Hopefully it was, but Gina did assure me that it was a big time presenter that bumped me. So
it was happy hour.
It was happy hour?
For happy hour.
Okay. I thought it was Jamie Miller, but I don't know. But so I'm glad to be here, and hopefully, you know, this is going to be a casual discussion. So raise your hand or ask the questions, and I'll try and answer them. If I don't have the answer, I'll get you the answer. And that's pretty much it. So a lot of the things you probably already have heard of, whether through the news or through your friends or things of that nature. But the due date, as you know, has been pushed back till July 15th to file and pay your taxes. So it originally was April 15th, and then when this all happened, obviously they just extended to July 15th. In addition to that, the 2019 returns are due July 15th, but also your 2020 estimated payments for federal purposes that were due April 15th and June 15th are now due July 15th. For New Jersey purposes, your first quarter payment, which was originally due April 15th, is now due July 15th. However, your estimated payment for the second quarter for New Jersey is still due June 15th. So, like I said, it's crazy times that that the second quarter is due before the first quarter for New Jersey, but that's how New Jersey did it. Do I anticipate them changing it? I don't know. That remains to be seen. You know, when this all started back in March, the federal government pretty much stated that the tax deadline was going to be extended till July 15th, and it was just immediate. And it really was until about April 14th that the governor of New Jersey decided to sign into law that the due date for New Jersey returns and payments was due on July 15th. So we were waiting. We were anticipating that they would extend it, but you know, it took till the last minute to do that. So I don't anticipate the governor extending the second quarter to July 15th, even though I think it would make sense. But that's what it is. So I know I threw a lot of dates out there to you, but again, your 2019 tax returns and payments are due July 15th. Your first and second quarter 2020 estimated payments are due July 15th. For New Jersey, it's your first quarter is due July 15th, and then your second quarter is still June 15th until further notice. If you still need more time to file, if say July 15th comes around or you're getting close to July 15th and you do not have your information yet, or you still need more time to file your return, you need to file an extension. And that extension extends your tax return until October 15th. So a lot of people, there's a lot of misconception out there about, you know, file an extension that it's an extension to pay. The extension is really just an extension to file. It's not an extension to pay. So you need to be aware of that, that everything needs to be paid in by July 15th, or you could be subject to penalties and interest. I don't know if there's any questions yet on any of the due dates.
Okay. Nothing that came through yet, John.
Okay, and also you just, if you file in other states, keep in mind that most states have also extended till July 15th, but you should really look toward the specific state that you might be filing in to determine whether or not you have a filing deadline that's coming up. Now, regarding one of the provisions of the CARES Act that was signed into law was this economic impact payment. And you've all heard about the $1,200 check that has come in or will come in, or the $2,400, depending on your filing status. What that is really a 2020 tax cut that is based on your 2018 filing or your 2019 tax return. So what the government's saying is that, the IRS is saying is, we're going to give you a tax cut in the form of an impact payment. And that impact payment is that $1,200 or $2,400 check that's coming. If you haven't gotten it yet, you will get it. Now, who's eligible for this payment? Because not everybody's going to get it. So you have to be below a certain threshold of income, depending on your filing status. So if you're single and you have adjusted gross income of $75,000 or less, you'll get this payment. If you're married filing joint, your adjusted gross income is $150,000 or less, you should get that $2,400 payment. If you're head of household and you're under $112,000 of adjusted gross income, you should get that payment. You also, if you have income above that amount, then that payment can get phased out at a 5% clip. So you ultimately get phased out, say you're a single taxpayer. If you have $99,000 of AGI, you would not get the payment. Also, you get an extra $500 for every qualifying child that you claim. So what's a qualifying child? A qualifying child is someone who is not yet 17 years old, who is claimed as a dependent on your tax return. So if you take someone who's you take a married couple who have 2 kids and they're under $150,000 of adjusted gross income, they'll get their $2,400 impact payment plus $500 each for a kid. So I would expect a $3,400 payment for a married couple with 2 children, 2 qualifying children. If you have a Social Security recipient, you automatically get this payment. You don't have to file a tax return to get the payment if you don't file a tax return already. So if you're getting Social Security, you should get this payment. If you're a non-filer, meaning that you don't reach the threshold of having to file a tax return, you should get the payment, but you would have to either file a tax return to get this payment, or you need to go to the IRS website and put in some information to get the payment. So if you go to irs.gov, there's a lot of information on there, whether you're eligible, what's the status of your refund, and also if you haven't gotten your payment yet and you want to use direct debit, you can put in your bank account information and they will send it to you direct debit. Just be aware of the fraud out there. I think it was Jesse's, if you were in Jesse's webinar yesterday, he talked about taking care of, elderly people, if they need some help, physically with shopping or whatever. What I will tell you with this is, fraud is out there. And unfortunately, these scam artists, they prey upon the vulnerable, and usually they're older people, and they will call up old people or other people, and they'll ask for bank information saying, hey, you know about this impact payment, the $1,200 or $2,400? Give me your bank information and I'll get you that money. And then someone will say, okay, and they'll give them the bank information, and then, they just got scammed. So I would tell your friends and families, neighbors, do not answer any calls from the IRS. The IRS will not call you. They will not email you. They will not text you. They will send you a letter by mail asking for any information that you may need. They will show up at your door, but that's if you owe taxes. They're not going to give you any money. So that's a different story. And of course, our firm handles IRS controversy. So if you have an IRS agent show up at your door, please call our firm.
Hey, John, question on that. Has the IRS started sending out these checks?
They have started sending out the checks, and it does go to your quote unquote last known address. It goes based on when your tax return was filed. If you, like I stated before, if you do a direct debit with your tax return, it should show up in your bank account automatically. You'll get that quicker. If not, then you'll just wait through it by mail through your last tax return. And like I said, it's based on your 2018 AGI, adjusted gross income, unless you've already filed your 2019 tax return. And this is not taxable. So when you get the payment, you don't have to include it on your tax return for 2020. It's not going to increase your tax or reduce your refund or whatever. This is, quote unquote, not a freebie, but it's a reduction in your tax rate for certain filers.
All right, John, and one question that came in. So for our elders who do not file tax returns, they can just go on the website and do it?
Well, if you're collecting Social Security, you don't need to do anything.
Oh, okay.
If you are not collecting Social Security and you do not file a tax return because you're under the income threshold, and I think the income threshold will be about $12,000 for single people or $24,000 for married couples, and you're entitled to this, you should go onto the irs.gov, put in your information, and they should give you a economic impact payment.
Hey, John, can I ask so the children that are over 17, will they get anything if they are dependents?
If you're a dependent, you do not qualify.
So anybody that's a dependent that's between 18 and 21, like all three of my kids,
Exactly.
get absolutely nothing. All right.
They get absolutely nothing. You know, and a lot of people have this, assumption. Well, if I just don't claim my child, will I get it? Either you're a dependent or you're not a dependent. So if you disclaim your child on your tax return, does not automatically make them not a dependent. You just didn't claim the child. I think you got to look at the whole picture. One of the frustrating things about being a CPA is that everyone thinks that it's all cookie cutter and that everyone's situation is the same as, well, my neighbor got a refund or my brother got a refund and how come I didn't? You kind of have to look at the situation. A lot of things go into play here. If you don't claim your child, let's say, do you lose the education credit or the child credit? These are big numbers, and you have to not look at the vacuum of a $500 payment versus the education credit that they may get. So you kind of have to look at it both ways, or look at the whole picture. So.
Okay. Yeah. So even if because they all filed taxes, but they said I claimed them as a dependent, and they said on there that they have been claimed as a dependent, so they won't get anything. Got it.
Right.
Okay. Thanks.
Okay. No problem. I don't know if there's any other questions on that topic. Also part of another provision in the CARES Act are charitable contributions. As you may know, the IRS gives you a choice of two deductions, either the standard deduction or an itemized deduction. The itemized deductions are really your real estate taxes, your state income tax, your charitable contributions, your mortgage interest, and then it's a standard deduction, which is based on your filing status, whether it's single or married filing joint, and that's just a flat rate. So when you take the higher of the two, but due to this coronavirus and the CARES Act, the IRS is saying we'll give you an extra standard deduction. If you don't itemize and you contribute to a charity, we'll give you up to $300 deduction added to your standard deduction. So if you take a standard deduction, and let's say your standard deduction is $12,500, and you give $1,000 to charity, you'll get a $300 extra deduction added on to your standard deduction. If you do itemize and you give charity away, the charitable contribution limit is currently 60% of your adjusted gross income. So if you make if you have adjusted gross income of $100,000 and you want to give away $70,000, you'll get a $60,000 deduction, and then the rest gets carried over $10,000. But the IRS has eliminated that AGI limitation under the CARES Act. So if you make 100 and you give 100, you get the whole thing written off. So that's with the charitable contributions. I don't know if you have any questions on that. Now on to retirement distributions. The CARES Act changed a lot of things on the retirement distributions, specifically regarding required minimum distributions. And what that is the IRS, in order to incentivize people to fund their retirement, they allow people to take their earned income pre-tax and put into a qualified plan, whether an IRA, 401k, 403b, and you let it in there and it grows tax deferred until you reach a certain age. The earliest you can take it out is 59 and a half, but the latest is 70 and a half or 72, and I'll get to that distinction in a little bit. So you're required at 70 and a half, let's say, to start taking out monies out, because don't forget, it hasn't been taxed yet and the IRS wants their money. So they don't want you keeping it in there indefinitely. So they require you at 70 and a half to take a certain amount out. And that certain amount is going to be based on the amount in your portfolio and your life expectancy. And if you don't take out the required minimum distributions, the penalties are pretty high, and they can be 50% penalties. So if your required minimum distribution is $10,000 and you don't take it out, you could have a $5,000 penalty. There are ways of getting around that or getting out of that penalty, but you don't want to have to risk that. So because of the downturn in the market, we've seen our retirement plans just absolutely plummet. And if you talk to any financial advisor, they'll tell you that, you want to buy low and sell high, but, the government doesn't want to force people to buy or to sell low. And that's what you're doing when you're taking the money out of your retirement distribution. So they're going to suspend any 2020 required minimum distributions if you don't want to take it out this year. So it gives that retirement plan, that portfolio, a chance, another year to grow. Also, early distribution penalties for qualified retirement plans are waived. As I stated before, you put this money into a retirement plan, when you're younger, you can't touch it until you're 59 and a half, under certain exceptions. Now, I really don't know why they always do the half, that there's 59 and a half and there's 70 and a half. I guess it was some kind of compromise between the two parties, that one wanted one and one wanted the other, and they split the baby in half. That's it just makes things a little more complicated, but it is what it is. So getting back to the early distribution, if you take it out before you're 59 and a half, you're subject to a 10% penalty. So you take out $10,000, you could be subject to a $1,000, before you're 59 and a half, you could be subject to a $1,000 penalty right off the bat. So, and you still have to pay tax on that $10,000. As I stated before, there are certain exceptions like first-time home buyers and things of that nature. You still have to pay taxes on it, but you won't get the penalty. What the CARES Act has done, it's stated that you can take out up to $100,000 before you're 59 and a half due to this virus that has gone around, and you won't get penalized on it. And in addition to that, you have 3 years to pay that tax on any of the income that you've been taxed on. So, for example, you take out $100,000, you're in a 30% tax bracket. That's $30,000 of tax. You have 3 years to pay that tax off. Or they give you the option that you could recontribute that $100,000 over the next 3 years. So you have 3 years to decide whether you want to pay taxes on it or whether you want to recontribute it. Just keep in mind that New Jersey still, I don't think, has followed federal on this. So New Jersey may require you to pay that tax all at once in 1 year if you decide to keep that money. There is no penalty in New Jersey for early distribution, though. And I think one of the items that was mentioned, and I think it was Jamie Miller's webinar, was the Roth IRAs. And what the Roth IRA is that's really funded with post-tax monies. And then when you take it out, when you retire, you pay no tax on the earnings ever or anything else. So it's really, after you make your initial investment, you don't have to pay any more taxes on it. So now's a good time, or a good opportunity, that with the depressed stock market and depressed portfolios, that you may want to consider rolling or converting that traditional IRA into a Roth IRA. And that is a taxable event, but you're paying tax at a lower value. There is some controversy or some talk about this 3-year rule of paying tax being applied to the Roth IRA. I haven't seen any clarification on that. I think it takes away from the spirit of the law. I think that the whole point of the 3-year payback or the $100,000 from a traditional IRA is to put the money into the economy because people need it to live, not to reinvest it. But there's still some clarification that's needed. But if there is a way to pay that off over a 3-year period, that's a pretty good deal, I think. So I don't know if there's any questions on the CARES Act regarding the retirement distributions.
John, one question that came in is, how does the 3-year payback work? Do you get like a invoice, or, has that been figured out yet?
No, I would imagine it goes onto your tax return. So you would include, there should be a line on there that says, IRA tax due to the CARES Act. I would imagine something of that nature will be on there. So it'll be just another line on your tax return.
Great, thank you.
No problem.
Hey, John, on the tax also, is it you pay, or you're taxed as if you took the money out this year, or do you get to take the money out over 3 years? And so with your example, I take out 100,000. I'm taxed as if I took the 100,000 out this year, or is it 33,000 each year for 3 years?
Well, my understanding is it's distributions regarding 2020, so you have to take the money out in 2020.
Okay.
Then
So,
I think the first year you pay the tax back is on your 2020 return. So I would imagine you have to pay a third of it on your 2020 return and a third of it on your 2021.
okay, but it's as if I took $100,000 out this year, and that the amount of taxes because of that is split over 3 years. Not that it's as if I could put 33,000 on my tax this year, 33 next year, and 33. You know what I'm saying? $100,000 might put me in a different tax bracket versus 33,000.
No, I think I understand what you're saying. You do have to take the $100,000 out in 2020. That's my understanding, that you have to do it in 2020, but you claim a third of it in 2020 tax return, a third of it in 2021, and a third of it in 2022. That would be my understanding of how that works.
Okay, what you just said was that you claim $33,333 this year. You claim as income, or do you claim the whole 100,000 as income?
No, you would claim it. You would claim a third of it.
Okay, that's interesting. Can I ask a second question if there's no others, Gina?
No, you're up, Andy.
Yeah, so I did ask this to Jamie, and I didn't particularly like the answer, so I'll ask you the same one. So, because you did say if you took the money out, 100,000 out, say, and then you redistributed that into a qualifying plan, is this an opportunity to diversify, say, taking out of a 401k and investing it into another qualified retirement plan? Jamie said no.
Well,
I thought I heard you say something different.
I don't know. This really has to do with IRA. If you're in a 401k and you're active, you really can't, it really depends on the plan, the 401k plan, but most of them, you can't start taking money out of your 401k as an active employee and put it into an IRA. You have to keep it in your 401k. I would think that's, the most common. I would think it's very rare that you're able to take it out of your current employer's 401k and put it into an IRA. I would think that's very rare. I'm not saying it's impossible. I'm just saying nothing's impossible, but I think it's
gotcha. Thank you.
So you're stuck with your Verizon stock there. Okay. Moving on from the CARES Act, I want to talk a little bit about another act that was passed at the end of 2019, which was a Secure Act. I think it's just kind of funny how the government comes up with all these positive acronyms. I guess, because I think the CARES Act, I think it's It means Corona Aid Relief and Economic Security Act. And I think the Secure Act is something like setting every community up for a retirement. They must pay millions of dollars to a marketing firm to make these acts seem so great. But I digress. So the Secure Act, and it relates to retirement plans, really moves the needle for required minimum distributions from 70.5 to 72. So you have an extra year and a half to keep your monies in the market, growing tax deferred. Also, you're allowed to contribute after 70.5 into an IRA if you're earning money after 70.5. And the rule is my understanding, the rule is if you're 70.5 as of December 31st, 2019, you fall under the old rules of being having a required minimum distribution. If you turn 70.5 after December 31st, 2019, you fall under the new rules under the Secure Act, meaning you could wait till you're 72 to take out retirement plans. They also changed, which is not a good thing, is the inherited IRAs, the rules for that. They used to be called stretch IRAs, and those are IRAs that were inherited by a non-spouse. So the rules for the spouse inheriting an IRA haven't changed. So if your spouse dies with an IRA, you get to absorb that IRA and treat it as your own, and it's taken out as if it was yours. If you're a non-spouse, meaning a child or a grandchild or whomever, you used to be able to, before this act, take it out over your lifetime. So if you're 25, you could spread out that IRA, inherited IRA, over your lifetime. But now you have to take it out within a 10-year period. So someone who's 25 who inherits an IRA from their parent has to have it taken all out by 35. So that could really impact someone having to pick up income, usually at their primary earning rates, as opposed to spreading it out over a long period of time. So that kind of hurt people who have inherited IRAs. I don't know if anyone has any questions on the Secure Act. I mean, there's other provisions or other rules in that, but those are pretty much the two basic ones.
John, if I may, we did have a question that came in, so I'm going to kind of break it up because it's 3 parts. And it's a client-specific question. So a client has taken their 2020 RMD already this year between January and March. When do they have the opportunity to put the money back into the IRA so they can defer the RMD until 2021 if they choose to?
I think if you have it less than 60 days, I think you could put it back, and I don't think there's a problem. I think if it's over the 60-day period, I think you may have a little bit of a problem. I don't know the rule in terms of if it's disallowed. I just think that it may be a little bit tougher, and I'm not exactly sure how you would handle that if it's over a 60-day period. But my understanding is if it's within a 60-day period, you should be able to put it back fairly easily.
Okay, and then the second part to that is, and Mike Flynn, I unmuted you as well, so if you want to jump in, will the RMD deferrals have to take double distribution in 2021? Do
you want me to answer that question?
Yeah, if you could.
Yeah, no, I think you don't have to take the double in 2021. I think you just skip this year and you're done. And then you just take it out based on your value and your life expectancy as of 2021.
Okay. Mike, anything that you could add to that? All right.
I think he says he can't use his mic.
Oh, he can't use his mic. Oh, all right. Well, if he chats us something, I will add that.
Okay.
Thanks, John.
No problem. There's a lot of things out there, with regard to the CARES Act and this whole virus thing. And I could spend a whole day on, I guess, the business piece of it. And I wanted to just touch upon it. We all know about the PPP loans, the payroll protection program. That money has been utilized. As of now, they're trying to refund it. I think it's a little bit of horse trading going on in Congress, but I do anticipate that happening. So if you haven't gotten your PPP loan, I would recommend you go to your bank and get online and get it, because I got a feeling this is going to pass, and it's going to be a first come, first serve. So get in there. There's a different loan. I think it's the EIDL loan. And that is a true loan that it's payable, I believe, over 30 years at 3.75%. So it's a fairly good loan. And then there's other like payroll tax deferrals or payroll tax credits that you may want to look into if you're a small business owner. And then the net operating losses, where, it used to be when President Trump passed this 2017 Tax Act, he changed the net operating losses that you couldn't go back and recapture any of the prior profits you had in the past, and you could only go forward. Well, this CARES Act has changed that. Now you can go back 5 years, because a lot of small businesses are probably going to have losses in 2020, and you can go back and recapture some of those taxes that you may have paid. That's pretty much all I wanted to go through today. If you do have questions, now is the time to ask. If
John,
not, then you could, obviously reach out to Gina or me directly, and I'll try and get you an answer.
John, a question did come in about the PPP. If I haven't received mine yet, do I need to reapply?
Well, it depends. I think if you've already gotten a confirmation number,
Okay.
I would think that you don't need to reapply. You'll probably be one of the first people in line for the second tranche. That's going to happen.
Got it.
I think you're only allowed to use your federal ID number once when it comes to the PPP loan. So doing it again may screw up your first application, but I would check with the bank that you applied to, just to make sure that you're still in the queue.
Okay, great. Any other questions for John? That was awesome. So informative.
Can I just say one thing about the PPP loan?
Sure.
As far as the loan is concerned, with your application that you put in, check the status of it and check to make sure that you have accurate numbers for your payroll. Because if you don't, then that might screw up your loan and delay it as well.
All right. Any other questions for John?
Okay.
All right. John, thank you so much. A lot of great information. It's overwhelming, the amount of information that you shared with us today. We appreciate this. As Andy said, this kind of was born from another webinar and a lot of questions that come in through the chamber office. So if there are other questions that you have or other webinars that you would like to see, please let us know. We are putting these together for the community. So please let us know. We have coming up next week and the week after is more on the PPP and the application process. We'll have a speaker, mortgage lending. We're going to talk about sanitizing and disinfecting your business when it's time to go back. And of course, we're going to have happy hour. So any other questions or comments before we get off? John, you're getting a lot of thank you, good information. Thank you. Great job. So kudos to you, John, for the information. Anything else before we close out?
Thanks, John.
Great. Thank you.
Dina. Thanks, Andres.
Oh, thanks, guys. And we'll talk to you soon. Look for the next email about the upcoming webinars.
All right.
Thanks all. Bye-bye.
Bye.